again, thank you all for joining us. The MBDA Coronavirus Response and Relief Team is happy to produce these webinars to make sure everybody is fully aware of what their responsibilities are regarding their business taxes. And without further ado, I'm going to introduce our expert, none other than CPA and tax professional extraordinaire, Nana Ageakum. Nana.
Hey, hello. That's nice. It's good to see everybody. Thank you, John. And John is going to tell you that he's actually one of the few people that can get me in the room. Those of you who've been trying to track me, they've been trying to track me for a long time. And I guess tell people that if they want to find me, this is where they can get 1 hour of my time uninterrupted. This is the 4th series, and this is going to be the last series for the tax part. We're going to talk about other things. We've covered a lot over the last 4 months, and this is where it all sort of comes together. Those of you who've been in the last 3 sessions, like Sabrina is going to tell you, and Ethan is going to tell you, it's been mind-boggling. It just opens John has been asking some really intrusive questions, and we've been like battling on it, and it's been great. I was looking forward to this. My name is Nana. I've been a CPA for about 21 years. I'm some of you I've met as clients, some of you I've met through Book. And I'm sort of looking forward to go through with you this webinar. Now, this year is going to be the most complicated year among all the years I've been a CPA when it comes to taxes. Why? There was a lot of credits flowing around. Child income credit that you were getting on a monthly basis, PPP, EIDL, grants, all these things that are coming up. And trust me, even when you even talk to the tax professionals who are actually making the rules, there's a lot of things that they've not figured out yet. And as we keep on doing, the things keep on rolling in, changes keep on rolling in. But what I want to do with you on this webinar is basically, in a very simplified way, sort of give you a structure which you can go by so that you can start getting yourself ready for tax season. So without further ado, John, if you can start sharing the slides.
One quick second, Nana. Too many windows open.
I know.
All right, here we go. And
great. So as I did introduce myself, my name is Nana, CPA, CGMA, AGY Associates, and that's my contact information. And today's topic is documents you need to get ready before filing your taxes. And the reason why when I spoke to John, and I did mention before that, this is important for a few reasons, right? And I'm going to give you a good example of myself. So 3 years ago, I filed my taxes, and I thought that everything was incorrect. And 2 years after, I get a letter from the IRS, and they state that, oh, you cashed out a 1099-R. And I'm like, 1099-R? Like, what are they talking about? Believe it or not, at that point, I had gone in and taken some retirement funds out, completely forgotten about it. But trust me, the IRS does everything. So they came in, they did the work, they remodified the returns, and they submitted a huge bill. The reason why I say this is because sometimes if you don't know the documents in which you need to gather, you may miss certain documents that you need to file your taxes. Because what it is that most of the documents, sometimes they don't send it to you. You may have to go into the portal or into whatever it is and print it out. That's on the personal side. On the business side of it, right, you also want to make sure that all your expenses that you've incurred, whether it be mileage, whether it be all these things, have you getting all that stuff? Do you have what you call a profit and loss statement? Do you have a balance sheet? How's that looking like, right? Because that's the profit and loss statement ultimately is going to determine what your tax liability is. So we've walked through a lot of this in the last few sessions, but what I want to use this session is just sort of brush through the overall, like on the 25 feet, 1,000 feet higher, like when they talk about taxes, right, what does it really mean? And if you can go to the next slide. So, so this slide, we're going to quickly review various tax filing forms from previous sessions, right? So basically we're going to review what we went to the previous session. But what I want to say is that, this slide is going to be made available also to the audience. In case what we're going to go through the tax organizer. In case you do need one yourself, when you go to my website, which is the link below, you're going to have one in a PDF version and one also in a Word version. You can print whichever one that you want, and you can basically start going through that. Don't let us scare you. It's about 18 pages, and we're going to try to go through the most important one. Not all of those are going to be applicable to you. That's why I want to briefly walk you through that, so that it may jog your memory what you think may be applicable to you, what is not applicable to you. But this is where you're going to find the information on my website. And if you click on this link right there, it's going to take you right to the tax organizer for 2021. Next slide, please. Yeah. So I've had a lot in the last few weeks. I've had a lot of questions about people saying that, oh, I have a business, I have an S corp. Do I need to file my personal taxes? Or I have an S corp. I did an S corp because I heard it's not taxable. And we've gone through this various sessions and other sessions, but I just want to break it down in a very simplified way, right? Whatever, if you have an S corp, you have an LLC, you have a sole prop, you have a 1065. Now, I did not mention C corp, I'm going to come to that. If you have any of those, whatever that you do on that front goes to your personal taxes. You're going to be taxed at your personal level, right? Because those entities are what we call a pass-through entity. The entity itself is non-taxable. So for instance, on the Schedule C, which is an LLC, it's part of your 1040. And when you do own taxes, whatever, like let's say your net taxes is about $4,000. You get your business revenue, business expense. That is going to go to what we call the Schedule 1 on your 1040. And that is going to be taxed as a self-employment tax. When you have an S corp, which is a question, which is a misappropriation that a lot of business owners have. Remember that S corps are not taxable entities, and I've said that over and over again in my previous sessions. So regardless of what you do on the 1120S form, you're going to have something that we call a K1. A K1 is going to then flow into your personal taxes, and that is how you're going to pay your personal taxes, right? And let me just jog your memory a bit about what we discussed the last time. Suppose you have an S corp and you don't pay yourself. Well, if you make profit, regardless of whether you paid yourself or not, you're going to be taxed at a self-employment rate, which is going to be a higher rate. If you pay yourself, remember, you're going to be an employee and you're going to be taxed at an ordinary income rate. The rule for an S corp is that you need to pay yourself a reasonable compensation as an owner, meaning that you have to make yourself an employee. That is the only time that the IRS is able to deduct social security benefits and other things like that. So don't think that the fact that you have an S corp eliminates you from actually filing your personal tax. No, those two goes together. The filing deadline for an S corp and a partnership, which is the same, a partnership also the same, is a K1, which is a pass-through entity that goes to personal. The two of those, when you talk about an S corp and you talk about a partnership, those are going to go into in the form of a K1 into your personal taxes. Now let's talk about.
Wait, Nana, I have a question. When I hear people talk about they set up an S corp and they don't pay themselves, and the reason that they don't on payroll, and the reason that they don't pay themselves on payroll is because they say they don't want to get double taxed. So could you explain that? Because I feel like that's the biggest misconception that clients have when it comes to why they got an S corp, right? Because someone told them this double taxation thing, and
that's what the C corp, right? Or the S
corp. The S corp. Now I'm going to explain the C corp later about the S corp. Yes. So let me.
What I'm saying is that clients make that misconception all the time, and I want him to clear that up.
So let me break that down. And Roxanne, we're going to come to this. The reason why I left the C corp out because the C corp is totally different. And I'm going to talk about that later. But let's talk about John's question about the S corp, which is very important, right? And I'm going to give a simple example, right? So let's say maybe Roxanne, for your business, you have an S corp, right? And you decide that, okay, you know what? I don't want to pay myself, right? So whatever that you have, you're going to report your profit and loss on your S corp, right? Your profit and loss in your balance on your S corp. Let's say you make a profit of $10,000, right? First of all, what the IRS is going to do, the IRS is going to penalize you, right? Because part of what it is, the requirement for an S corp is that you need to pay yourself a reasonable compensation. Now, in the beginning, John, I spoke about what we call a pass-through. So once a pass-through, what means that the S corp in itself as an entity is not taxable. Now I'm talking about the S corporation. It is not taxable, meaning that whatever that you do on the business side, when you do the 1120, the only thing that is doing is generating what we call the K1, right? Which is called the owner's form, owner's schedule. And the K1 is what you're going to use to file for your personal taxes, right? So let's say you decide that you're going to pay yourself. Let's say you pay yourself $3,000. Let's say you make a profit of $5,000, and maybe you pay yourself $3,000. So what the IRS does is because you paid yourself $3,000, right? Those $3,000 is going to be taxed at ordinary income rate, which fluctuates, which is going to be lower. And guess what happens? Although the $3,000 is taxed, remember that $3,000 that you pay yourself as an employee is also a business expense as part of your S corp, right? And because the S corp is not taxable, you get to reduce your tax liability, and your K1 is going to show $2,000, which is going to flow through into your personal. It's not going to show $5,000. So when it comes to double taxation, it's a misconception. The double taxation concept does not exist when it comes to an S corp in a partnership because the entity itself is not taxable. It's just a pass-through entity. So when you hear people throw around pass-through, all you're doing is you're generating your K1 so you can report it on the personal side. Everything is taxed on your personal side. That is why when I started off, I just want to make sure that everybody in America, if you're over 60 years old, you made income, files personal taxes, right? And if you have an S corp, you need to file your personal taxes. Does that answer your question, John?
Yeah.
Now, I want to give one more example also on this topic. So I had a client a few years ago who came and said, hey, I just did my 1040 and if you could do my business taxes for me. So the first question I asked them is that, okay, what's the legal structure of your business, right? And she said an S corp. I'm like, well, you need to do an amendment because you cannot do your personal taxes without filing an S corp. That's the first thing that every CPA or an accountant or a tax preparer should ask you, that if you have any business, because all the business, with the exception of the C corp. Now let me talk about the C corp for a second. So the C corp is a taxable entity, right? Meaning that, and first of all, nobody owns a C corp. Like when you talk about a C corp is not owned by an individual, right? A C corp is just set up and shareholders actually own it. So the C corp in itself, when you look at all these big corporations, the C corp in itself is taxable, right? So if the C corp makes 5,000, the C corp is going to get taxed. Now the question is that, what happens if you own shares? Like if you're a sole member of a C corp, right? The only time that is going to affect you on the personal level, because the C corp is going to get taxed, is when you take out something called dividends. Meaning that you're allowing the company to pay you. That is what we call the 1099 DIV. And even if you know, some of you get a 1099 DIV because maybe you own like 0.2% shares in Apple. You're going to say,
is that like when let's say the C corp profited $2,000 and you get a 10% of that, so the C corp has to give you a dividend of $20. You're paying taxes on the $20.
Exactly, and that is
actually it's 200. I'm sorry.
Exactly. They're going to pay a percentage of that. But remember that because the C Corp is a taxable entity. If you make a profit, there's no requirement to pay out dividends. That's why you hear a lot of corporations, they say that, hey, you know what, we're going to roll over the profit is the following year. And the IRS is okay with that because they've already been taxed for that income for that year. So that income is going to roll into what we call retained earnings, which is going to go on the balance sheet for the following year. So they want to keep on accumulating that revenue or that retained earnings. What an owner can do is the owner can say, okay, you know what, we're going to pay ourselves double dividends this year, or I'm going to take a loan. So a C Corp in this structure in itself is where we're going to talk about double taxation, right? The only thing that comes in a little bit is going to be a C Corp, where the C Corp itself is taxed, and you take out dividends, right? And the dividends is going to be taxed as well. That is the only time that you may see that you're going to be taxed both on the money received as a dividends and you're going to be taxed on the corporation itself. That's why a lot of owners, that if you're a single member owner, the whole requirement is that what did you do an S Corp? That's the main difference between an C Corp and an S Corp.
Well, then let me ask you a question. Let's say me and Ethan are shareholders in a C Corp, right? The C Corp profited $2,000. But instead of doing retained earnings, we took that $2,000 and we paid each other on W-2, the $2,000 that we made. Then the C Corp really had no money. Actually, it ended up losing money because on top of the $2,000, they had to pay employment tax for the two employees, right? So then the C Corp doesn't pay any corporate tax because it didn't make any money. It carries a loss over to the next year, and then we pay taxes as employees on a 1040, right?
Remember, so let me explain this to you. So for instance, if you work for an organization, right? So if you have a C Corp and you are an employee of the C Corp, it's just like being an employee of any other regular corporation. Right?
Because like if you have a C Corp, it's a separate entity. It's its own entity, right?
Exactly.
And a lot of people like myself have C Corp many years, 20 years C Corp.
Exactly.
But I don't have employees, right?
Exactly.
So, but if I pay myself, it's as an employee. So when they talk about the double taxation, they mean if I pay myself, I got to pay corporate tax on those earnings, and I have to pay as the person who's an income on a W-2 to my own company. So that's why some people say, oh, double taxation, because of the veil between my company, the C Corp, and myself personally. If I'm not careful, if I'm not observant, I'm ending up paying myself, yes, but I'm going to pay tax twice. Once as the corporate entity, and then once again as an employee of that company. If I draw a salary.
But here's my question, Roxanne.
Yeah, you got it. So Roxanne, you got it. Just to add a twist to that, right? So you're spot on. Now, the other thing that I say is that if you do pay yourself, remember that the C Corp is a legal entity. You also get to deduct those as a business expense.
That's what I was going to say. You could deduct those as business expense.
So it's not like it goes away. Your taxable, so your C Corp is not going to pay as much tax, because if you decide that the C Corp is $5,000 and you decide to pay yourself $4,000, the C Corp is only going to be taxed on $1,000 income, right?
Less than that, because they have to pay employment tax too.
Exactly.
So
exactly. Or even less than
so
that.
then you'll be paying less than $1,000 taxes on less than $1,000 earning, and the employee or you will benefit from Social Security, from getting Medicare. So and you're really only paying half the employment tax, because the employee pays half and then the corporation pays half. So you're actually getting a deduction on taxes by paying yourself as an employee.
In addition to other expenses that the company also incurs. Right? Yeah. Yeah.
So that's something that's also very interesting. All right, cool. So C Corp done. Let's there's a question about 1040 itemized Schedule A. When would a person use an itemized deduction Schedule A?
Yeah, I love this question. I guess we kind of did this question together in the other sessions that we had, right? So let me just take that. So in the last session, and John, maybe we can share that slide with people as well, because I think that breaks it down a little further. So the thing about itemized is that when you go to the next one, it's always, and it's going to be on the next slide as well, I think. There's something we call the standard deduction, and there's something we call the itemized deduction, right? So the goal is that the standard deduction, your itemized deduction, which maybe, and what includes an itemized deduction, home mortgage, right, real estate taxes, right, charitable expenses. And I had a list of all those, I just took it up on the slide. All those lists of what is itemized, right? So you add all those things together, right? The idea is that your itemized deduction should be more than your standard deduction, right? And if your itemized deduction is less than your standard deduction, then you go to default to your standard deduction. And we have John, maybe we can go to the next slide and let's just look at it. So these are filing status. So when you look over there, so when you look at the standard deduction, right, every year, right, the standard deduction goes higher, right? So what is going to happen is that the higher the standard deduction, the less likely you are to actually use an itemized. That's a lot of itemized deduction. That's a lot of people who bought homes last year because the standard deduction was so high, they didn't really have any benefit of it because either that they had a low interest rate, either that when they added all the stuff in, it was still less than $12,400 if you're filing single. If you're head of household, it was less than $8,650, right? So most of them defaulted to the standard deduction. So the only time that you're going to use an itemized deduction is if it's more than your standard deduction. And your standard deduction is affected by what your filing status is. Are you filing single? Are you filing married, filing jointly, married, filing separately, head of household, or qualified widow or widower?
Okay. All right. So if I'm filing married jointly, it's 24,800 is my standard deduction. So when I do the math with all my expenses, that could be deductions itemized. If it doesn't add up to 24,800, then don't waste my time.
Yeah. And remember that there's a difference between, a lot of people are business owners. I just want to make sure that I'm making this point very clear. There's a difference between what your itemized deductions are and what your business expenses are. Those are two totally different things. We shouldn't confuse the two. The itemized deduction is on a personal level. Home mortgage, real estate, maybe
education.
Education, unreimbursed, unreimbursed medical expenses, which is capped, right? Charitable expenses. So there's a list of that, and just reach out to John. I had other slide. I list all those stuff out in my previous slides, and you can get all those examples of what you think those itemized deductions may be.
So right? Co-payments are unreimbursed medical expenses, then,
yes.
Right?
Yes. So co-payments that you pay, but the only time the co-payments is the co-payments are so little. And remember that it's always capped at 2% of the AGI. So remember that this itemized deduction, there's always a cap. You can't collect everything.
Adjusted gross income? Exactly,
adjusted gross income, exactly. Yes. Thanks for, sometimes I throw these jargons, thanks for bringing me back to normal health.
No, listen, I listen, Nana, you know that I try to bridge the gap, right? Because I've learned a lot through you, right? But I understand where everybody else is at because I was there, right? So I'm trying to you live in this world. This is like second nature to throw these words out there, right?
So are there any other questions before we move on to the
we have a question in the chat. From Fatumata Murray. The question is it better to have an LLC or S Corp if you are the sole proprietor or employee?
So if you're a sole proprietor.
All right, so hold on. That's a little bit confusing, right? If you're a sole proprietor, all right, LLC, S Corp, and sole proprietor are all legal statuses of a business. You cannot be a sole proprietor and an LLC. You can't be a sole proprietor or an S Corp. If you're a sole proprietor, it means you're doing business as yourself under an assumed name or a DBA. If you have an LLC, that's a separate entity from you, and you are a member or employee of the LLC. If you have an S Corp, it's a pass-through. Nana, you explained that earlier.
You're right. If you're an S Corp, meaning that you just filing, you have a corporation, you register, it's a legal entity. So just to add to what John is saying, right? So it's called the legal structure of your company, right? And there are various ladders of what we call what company structure is going to be. So the first thing is called an independent contractor, which is called an unregistered business, meaning that it's just you by yourself. You have a gig, right? You get paid, somebody pays a 1099, right? You don't have to go register the business, right? They just pay a 1099. So all you're doing is that you just report your 1099 and you deducting your expenses. You're going to use a Schedule C, right? You don't register the business. It's not a registered business. You just independent contractor, freelancer, right? If you are a sole proprietor, you go to the county clerk's office, you get a form, and you just fill that out. That's the other level, right? It's not really a corporation, anything like that. Now, if you want to incorporate, that is where you decide that am I going to choose an LLC, an S Corp, or a C Corp, and that's the determination you're going to make based on your business needs. So, if you're a single member, you want to decide, okay, do I really want to have an LLC based on my business? Which recommendations? Yes, if you're a business, you want to have an LLC because it also protects you from somebody piercing the corporate veil, meaning that in case there's a lawsuit or whatever, the liability doesn't come to you personally.
Yes,
right?
Yes.
It goes.
You want to be legally protected. If you have
Exactly.
a business where somebody could get hurt, if they do, they'll sue you and take everything for you. But if you have an LLC, then they can't sue you. They'll sue the LLC. And if the LLC doesn't have anything, what are they going to take?
Exactly. I know there's some other question. I don't know if the lady wants to come off mute and maybe we can jar this question off. Ethan, I know there's some follow-up questions on that.
Yeah, so I see Fatima followed up with that. Do you want to unmute yourself and
yeah, Ms. Murray, come on, let's hear your voice.
Hello, can you hear me?
Yes, we can hear you.
So, thank you for clarifying. So I have an LLC and I'm a therapist. So I do, therapy, but I also I opened a consulting company 3 years ago.
Okay.
The whole purpose is to sort of do trainings and provide services to agencies and companies and all of that, as well as therapeutic programs. And so, but it's just me. A lot of it is behind the scenes, just programming stuff. So someone told me that I shouldn't file the way that I was filing because I don't know if they said I'm double taxing myself because it's just me. So I have a Schedule C. I've had an accountant, he did the Schedule C, but I don't know if, I am an LLC and it's just me for now, how I should be filing those taxes.
You just talked about this double tax thing too.
Yeah, you're doing it the right way. I mean, I don't like when people keep on throwing out the word double taxation because
I wasn't because I was like, I need a new accountant. I still need a new accountant, but I'm just saying.
Yeah. So I said people are confusing you, but you're doing the right way because the only thing that if you're a single member LLC, the only thing you're going to file is your Schedule C, which is going to list your business revenue and expenses. And based on that, you're going to pay taxes if you made income, right? On a personal level, right? There's really not much that you want to do on that aspect of it. But what is going to happen is that, so let me tell you the difference between if you set up two businesses, right? So a Schedule C, people can have different Schedule Cs based on the business that you have. So let's say, for instance, you have your therapy business, right? It's called, your name in the LLC. That's the therapy business. It has an EIN number, right? So when you're filing your taxes, your Schedule C is going to have that. Is going to ask you the business name. It's going to ask you the profession, like basically, it's called what the code, what the NAE code, which describes the kind of industry that you're in, and it's going to ask you for your EIN number, right? So based on that, right, you're going to also add your social security number in case you want to, but you don't really need to because everything flows to your personal. Based on that, you're going to have for that particular business your profit and loss, right? Now, let's say you're doing some other gigs on the side, right? You do other things that are not part of the therapy, right? That is on the side. So the question is that how do people pay you? Do people pay you based on the LLC company, or people are paying you based on you as an individual? So if somebody gives you a 1099, or somebody says, I'm going to give you a 1099, somebody writes a check in your name, rather than the company's name. If they write a check in your name with your social security number, then you cannot combine that with your company because that is not your company doing the business. Now it's you. So now you have to depart a different Schedule C as an independent contractor, listing the revenues and listing the expenses for those, right? So you want to be careful that's why I always tell my clients that if you do business and somebody's going to pay you, when you fill out your W-9, right? The W-9 form should clearly indicate how you want to get paid. meaning that you want your business name on it, the business EIN number, and tell the person directly that I want you to write all checks to this business name, because that is how I'm going to file my taxes. But once they start writing the checks to you personally with your social security number, it's not going to go under the business. It's going to go under you as an independent contractor. Does that make sense?
Yes, thank you for the clarification and adding that last piece to it. Thank you.
Anna, I think you're interviewing right now for her new accountant.
He is.
We have another question from Roxanne.
Okay.
Roxanne says,
Roxanne, you want to come off mute?
So we have the 19-year-old. She has her first return. This is her first return ever.
Yeah.
Okay. She had a paid internship.
Yeah.
So she has a W-9. That was a job.
Okay.
She also is a sole proprietor. She has a real business that she filed a DBA under her own name. It's not it's a sole proprietorship.
Okay.
And she earned a little bit of money with her business.
Okay.
That she wants to claim on the taxes because she's going to try to get an MWBE certification, right?
Okay.
So does she file the 1040 and a Schedule C or a K1?
So it's a 1040. So the question that I got, so first of all, she's going to file a Schedule C. So there's really, because she is not an S Corp, she has nothing to do with a K1 or a partnership.
Okay.
Now the question about the Schedule C that I want to really make sure that I'm emphasizing is that you did mention two things, that she has a sole prop that she has set up and she made some money on it. That's good, one Schedule C. Now the other question is that the other thing that she did that she got paid, was she paid based on as the sole prop, or she was paid based on her as an individual?
Right, she was an individual employee, so she has a W-9. It just came in the mail.
Yeah. Now the good thing about sole prop is that does she have an EIN number?
She didn't do the cloaking EIN number. She has.
So that's fine. So she can combine both because she's still under her social security number.
Yes.
So she can just put her name and her business name as sole prop. But the fact is that the IRS is going to identify her by her social security number. Because what the IRS is going to do is they're going to check all the 1099 that have to them. If the 1099 is under a social security number, they're going to look at their social security number to make sure that the income that you're reporting is what has been reported to them.
Right. So, and if it's her incidental income is Schedule C, right?
Is that what?
The incidental earnings that she made with her company is reported on the Schedule C.
Now, how did the company pay her? Did they pay her 1099?
No, she had clients, so they just paid her electronically for services.
Now she filled out a W-9, not a W-4, a W-9, right?
Most of them didn't ask. She's a notary. So she just charged people for notary and virtual notary and delivery service.
So most likely they pay her as an independent contractor. So it's a 1099. She's not an employee, because if
no, she wasn't an employee.
Yeah, right. So she's going to report that. So that's going to be part of the revenue. But remember that for every revenue that she has, she needs to understand what those expenses are offsetting. Because if she made 5,000 and she just puts in the 5,000, she's going to get taxed on the 5,000. But guess what? She had the notary fees, she had all these expenses, medical, phone bill, all these other expenses. If she doesn't deduct it, the IRS is just going to tax her on that amount. So
right. So we're I'm accustomed to doing my schedule, my corporation, so I know how to do the expenses part.
Okay.
I just wasn't sure, like, okay, she's filing as her own person on a 1040, and she just has a Schedule C showing this other income.
Yeah.
And her expenses on that Schedule C will show up.
Yep. Right. That's right.
Thank you.
All right. Any more questions, Ethan?
Yes, we have a question from Ninoska Alvarez. Do you want to unmute yourself?
Yeah, sure. Hi, everyone.
Hi.
So this question, I asked when you guys were talking about paying yourself as a S Corp. So I'm a sole proprietor LLC. So I was just wondering, how does that come about? Because this is a question that I've been trying to find an answer to for a long time. So I do have an LLC and it's under sole proprietorship.
Wait, it can't be both. It can't be both. You can't be a sole
proprietor. What she has
is a single member LLC then,
exactly, you have a single member LLC.
That's
what I was going to say. It's called a single member LLC.
All right, well, then LegalZoom needs to change their stuff. So So basically, what I'm trying to figure out is how do I pay myself from the earnings that I acquire? Do I just wait till the end of the year? I know that someone said that they basically pay themselves weekly and then they file like a 1099 every week. And then that's like the only other reference that I have. So I don't know how to do this. So
now this is a great question, because the PPP, a lot of single member LLCs actually got confused with that. So the great news for you is that you don't need to pay. You don't need to set up how to pay yourself. You can pay yourself, like you don't even need to pay yourself, right? Because what it is that if you're a single member LLC, the IRS assumes that whatever money that you make is the money that you pay yourself, right? So that's the assumption. So if you make 100,000, you can decide to keep all in your bank account, but the IRS is going to tax you on 100,000 because that's what an LLC is for. Your net income is basically the amount that is paid to the owner. That's why it is flown into your personal taxes. That's why it is taxed as self-employment. So whether you pay yourself monthly, you pay yourself, like in the eyes of the IRS, they don't really care. All they care about is the whole year, how much money did you make, and this is how much we're going to tax you on. That makes sense?
kind of, yeah. Then my follow-up question is, if I was to have an employee, how do I pay them? Because I'm in the middle of trying to hire someone. So how would I pay them under the LLC?
So you just have to roll them as an employee. So what is going to happen is that they're going to become an employee of an LLC. Like I don't have an LLC, I do have a couple of employees. Mm-hmm. But the difference is that now it's going to become an expense, right? Salaries is going to be an expense, right? So when you do your profit and loss, there's going to be one line item that's called salaries and wages expense. That is what you're going to report it as. But your employees are going to get what we call the W-2, right? And they're going to get, you're going to get a W-2 at the end of the year and the pay stub. Right. But you are just going to deduct it on your side as an employer as a business expense. But for you, as an owner, whatever money that is left, the assumption is that that's how much you pay yourself. But you can decide that you can put yourself on payroll. So let me explain this. You can decide as an owner that you can still put yourself on payroll. If you put yourself on payroll as an owner, now you're going to be taxed at an ordinary income rate rather than a self-employment rate, which can be different, right? The assumption is that the self-employment rate is always higher than the ordinary income rate. And the good thing about put yourself on payroll is just because you already get federal taxes withheld. So at the end of the year, you're not worrying about the fact that, oh my God, how much tax am I going to get paid based on the month that I made, right?
Not only that, you're reducing the tax burden of the business.
Exactly. If you're not making that much money, then there's no point to pay yourself. You're making like what, $1,000, maybe it's $5,000, maybe a year. No, it's not that much difference between self-employment and ordinary tax. But I'm talking about once you start making significant income. That's why usually businesses that are LLC, they come to me, they ask me a question that, oh, somebody told me that I have to switch from an LLC to an S Corp. Now, guess what? Anything that you can do on an S Corp, you can do on an LLC, right? The only difference is that, you have a corporation, which in New York State, you're going to pay $250 on franchise fee, but it doesn't really make that much of a difference, to be honest with you.
Gotcha. Thank you.
No, we have a question that came in that Ethan might not be able to see. Well, what is the penalty for not being on salary as an S Corp?
Now it depends. There's no magic number. I can tell you right out there for sure. But what I know is that the IRS is going to tax you at a higher self-employment rate, right? So definitely, if you're making somewhere. But the reason why people don't feel it is just because of the fact that you may not be making that much, you didn't make that much money, so you don't see the difference. But once the percentages start adding up, right? So just a figure, right? Let's say on an ordinary, so when it comes to self-employment, the rate is maybe like 15.6, but ordinary income is usually depending on the taxable bracket that you fall in, right? Based on your expenses, so based on your taxable amount, your net income. So if your net income is like 5,000, you're going to fall in the lower bracket, which is going to be like anywhere between 5% or 6%. There's a tax table that goes all around that. But the whole goal is that if you are filing your taxes and you're getting all this expense deduction, your tax liability determines where you fall within the tax bracket. And those days, being a CPA since 2000, 2001, we didn't have all these fancy softwares. You actually had to go, if you did it manually, the IRS had this like 60 pages of all these income levels. And based on your income level, you're going to go across and you're going to see what your tax liability is or what bracket you fall in based on your income level. So that's how it's basically calculated, right? There's no really magic number to it. All right. Any more questions? But I think this is the nuts and bolts of it before we go to the checklist. But any more questions, Ethan?
That is all we have so far.
Okay, great.
Thank you.
Now let's move to, I think the next slide says, let's go to the next slide. Okay. So now we're going to try to review these forms based on time permits, right? And I think the most important form that we want to talk about is going to be the tax organizer. And then we spoke about the Schedule C, right, which is the LLC sole prop, and we can show you just a copy of that. 1120 C Corp, 1120 S Corp. Now, this is just to kind of give you an idea about how the form looks like, but we're really going to dive into the tax organizer to kind of highlight some key points. So if you want to click on the tax organizer. And now remember, as you click on this tax organizer can also be found on my website using the link that we provided. So Ethan, if you can go all the way up. So this is what we call the tax questionnaire 2021 tax year. Now, one of the things that I'm going to tell you right off the back is that it says 18 pages, but don't let us scare you, because everything that we've spoken about for the last hour or so is going to not start making sense over here, right? So basically, this is what I'm going to send the client to make sure that they're preparing. Everybody knows their name, their occupation, their address, right? Now, the part that I'm talking about that we're going through is going to be the filing status, right? Now, the filing status, remember I went through, what's your filing status? Are you filing single? Are you filing married, head of household, qualifying widow or widower or spouse? Now, John, this is a question that I have for you. Sorry to throw another bus. Why is it important to know what your filing status is?
Is it because it tells me what standard deduction you might use?
You're a smart guy, you know it. It's like, you've been to yeah, exactly, spot on.
I've just been with you for too long, Nana. I already know.
It tells you what your standard deduction is going to be. And why does that matter? That matters because if you have an itemized deduction, it's your standard deduction more than itemized deduction. And why does that even matter? Because your income minus your deduction is going to determine what you call your taxable income, which is going to show how much taxes that you're going to pay or what brackets that you're going to fall in. So that is why all that matters, right? I just want to pause about that. Is there any question on this? Or I think the reason why we went through the first slides is just kind of prep you for these ones. So Ethan, any questions on that? Or we can just go ahead.
No questions.
Okay, great. Now the other one is, virtual currency. They threw that in there, right? And the next up is going to be an interesting one. Now the virtual currency, a lot of people are doing Bitcoins and all that stuff these days, right? Guess what? It is taxable, right? So, I want to know if you have any virtual currency. Did you sell, exchange, otherwise dispose of any virtual currency? Because
I was about to say, you have to sell it in order to be able to, right? So if you're still holding the virtual currency and you never sold it, it's fine. But if you made $30,000 in Bitcoin and you sold it, oh boy.
Now, you're spot on, John. I think we went through that. So remember what we went through, that we had something called the 1099B, right? So what is going to happen is that if you get that form, you have to see if you sold it. Like if you didn't sell anything, you get that form, there's really nothing to report because you're not going to be taxed on stuff that you've not sold. John is spot on that. Right. So remember that, you want to be able to, I don't know if anybody's a Bitcoin or all that stuff, but that creates this whole level of complication. And it makes your tax payment, it makes your tax fees from the CPA goes up because CPA don't like to deal with all this stuff. The other question, the other one that is a hot topic, advanced child tax credit payment. John, do you have any question? I know you have a question on this.
All right, so check this out. I have a child, right?
Mm-hmm.
I also have a W-2. I actually have multiple W-2s.
Okay.
And I also have a Schedule C, right?
Mm-hmm.
I had no clue whether or not I was going to benefit from the extra tax credit or if I should take it in advance. So I decided to opt out of getting the extra $250 or $300 a month that everybody was getting. Now, the IRS, they're funny, man, because they sent me a letter and said, if you don't want to take it, you have to opt out. We'll send you more information about it. Next thing I know, a month later, I got money in my bank account. I didn't get a chance to opt out. Went to the IRS website, opted out immediately, but I already got one payment. It was for $250 because my daughter's 7 years old, right? I was upset because I wanted that extra $1,800 to be added on at the end of all my deductions because I didn't know. I don't know if, like, can you imagine getting $1,800 and then then at the end of the year you have to pay taxes because you got that extra $1,800? So I opted out and then received a letter recently saying, oh, we only paid you $250. Great, awesome. I threw that letter away, not knowing. My tax preparer calls me. He's like, hey, if you get this letter, don't throw it away. I already threw it away. So I had to go online, log in, and get the IRS website to show me that they only paid me $250 in advance so that I can get the rest of my advanced tax credit added on to the original child's tax credit, which is what, 3,600 minus 250. We're talking about 3,350.
Yeah,
is going to be my deduction for my child.
Yeah.
Right.
Yeah.
So my question is, will I be able to use that instead of the letter that I threw away? And then there's supposed to be another letter that says what I got in my for my stimulus checks.
Yes. And
I don't know where that is.
Yes.
I don't know where that is.
Yeah. So you need to keep track of that. So your dilemma is a lot of dilemma that a lot of people don't know. So I just want to just take it from step one. And you explain it beautifully. So what it is that, remember that the word advance, right? Advance, child tax credit. Like when somebody says advance, what does it mean? Advance means that we are giving you the money that you're supposed to get ahead of time. We are going to give it to you in advance, meaning that we're going to give it to you sooner so you can use it. It didn't say free, it said advance. So what that means is that whoever opted out, if they do decide that they qualify for child tax credit, which remember that information that they had was based on your 2019 or your 2020 taxes. So not everybody qualified, but they went there and they realized that, okay, based on your 2019 or 2020 taxes, this is how much amount that you qualify for. So what we're going to do is we're going to split it into 12 months with the assumption that your situation did not change in 2021. We're going to give you that money in advance, right? Now, the key question is that, what about if your situation changed in 2021 and that money that you got, they overpaid you? So guess what? You're going to pay that money back. What about if your situation changed and they underpaid you, you're going to get extra credit? So John, to your question, that doing the preparation of taxes, the question that you're going to ask is, did you get any advanced child tax credit? If the answer is yes, the question is that, did you get a form and how much did you pay? And remember that it's a good thing that you know the figure, because they're going to tell you to put that figure in the system. And the IRS is going to corroborate to make sure that the figure that you have is the same figure they have at their end. If
I'm
it's
so
different,
glad I cut it off. I'm so glad it was only one payment because it was real easy.
Yeah, if it's different. And right now, the thing I'm going to tell to everybody here, and those who are joining right now, I don't know why more people don't join this, because you get like really good information that you're not going to get from your CPA or whatever it is. Even me as a CPA, my client, I don't sit down with them for this long. What I'm going to tell you now is get on the phone tomorrow and call the IRS for them to send you a statement of how much child tax credit that you owe. Because guess what? They're getting busy and busy by the day. And once it hits next week, February, even now, you're not going to get a hold of them.
But Nana, I logged on to the IRS and got a statement from them. But you can't print it. You have to print the screen.
Exactly.
In order to get it.
So do that right away, because that's information that you need, because that is really going to determine whether you're going to get more, you're going to get stuff taken away, or you're not going to get anything, because it's an advance. An advance is against your 2021 that you're supposed to get, right? They say enter aggregate amount of advanced child credit payments you received for 2021. This amount to include on this line are found on the IRS letter 6419. Okay.
We have a question, Nana.
Yeah, I know there's going to be a question on this.
It was not on this specifically. You know how we talked about Bitcoin?
Yeah.
Well, this one's about a Roth retirement mutual fund. If you do not touch it, if you do not pull money from your fund, you do not have to pay anything on that, correct?
Absolutely right. And that's called a 1099-R. Absolutely right. Yeah, you don't have to pay anything on that. Yes.
Okay. All right. And then I guess now we're talking about 2021 economic impact payment.
Yeah.
Is that like the $1,400 that we were getting from the government?
Yeah. Some people got 3 rounds, some people got 2 rounds. So you need to know. So listen, the IRS is going to send you all these letters. It's called the IRS notice called 1444-C, your 2021 economic impact payment. Log on to the website and try to get this form. Right? Now, what I'm saying is that I'm glad you guys who joined are really, it's great that you joined, because most people are going to get this and they're going to become the accountants when the accountants preparing tax, and they're not going to get a hold of them. I'm going to tell them one.
They're not going to know.
No, nobody's going to get, and they're not going to know what to produce, and the accountant is going to put yours at the back pile before you realize you're filing for an extension, because they're not going to have time for you to babysit you to go through all these things. That is why it's really important that you get these documents together, so that once you get your accountant, tax preparers and accountants like people that come in with already all the information. Trust me, you're going to be the first person to get out, because they know that they don't have to go back and forth with you. If they have to go back and forth, they put you behind the pile.
Yeah, my tax preparer hasn't. I'm always ready for him.
Yep.
I have everything for him. He's got me in and out, and I get my refund in at least a month.
Yep.
But the problem is, I have to go to his office because he's not answering his phone for me.
Nobody is it. Listen, this is the only time that you can get me to speak for an hour and a half, John. I mean, people that have tried to track me know that. I don't answer my phone. I just at this time of the year.
If
you want to scroll down, Ethan. Now, do you have any questions, Ethan?
There's a question about the stimulus. So
yeah, the stimulus. So can we go back over that, because I do my own taxes, so this is going to be the first time that that I'm seeing the stimulus or whatever that thing.
The economic impact payment.
So Roxanne, so what is going to happen is that, within what software do you use? TurboTax?
Yeah, I just started using TurboTax. I used to just do it the old-fashioned way, get the forms from the library and fill them myself.
Yeah,
I'm a little old school. But last year I did TurboTax now.
Yeah, you use TurboTax. Use TurboTax tax card. Use the software.
It makes it easier.
Library.
Yeah, because the library in the old days, you used to get all the forms, they lay them out for you, pick them out, and then you do your taxes.
Yeah.
But now TurboTax much easier.
So what they're going to ask you is so you want to make sure that you have this form, the 1444-C, right? So if you don't have it, go to the IRS website, log in, and try to get the form printed out. Because what TurboTax is going to ask you is that, did you get this form? Did you get any? They're going to ask you a question. Did you get any economic impacts payments. The check is going to be check yes, right? Then it's going to be like, look at your form, this form, and take the number that is on this form from like box number 1, right? So they're going to tell you that. So that's what you're going to enter, and based on what you enter, right, it's going to let you know whether you're going to qualify for extra credit or you're going to qualify for no credit, right? For TurboTax is such a but for the CPAs, right? We don't get a question and answer. So basically, if you have a CPA in your tax, or you have a tax preparer in your tax, you go to and I know somebody who said they're a tax preparer. Basically, you want to make sure that you're asking all your clients that, give me this form, because a lot of clients don't know they have to give you this form, because on the tax software, you need to go in and look for where you need to go in and look for where it actually asks that question and check it and make sure that you enter one number that is telling you to enter. TurboTax is going to actually do the Q&A for you, but if you use the professional tax software, you just have to know where to put in the numbers and just make sure that they give you in this form.
So the form is 144-4C.
That's C.
That's the form?
Yes. IRS notice. So that's the IRS notice they're going to send to you.
And if you can't find it, you can go online and look for it?
Yeah. Like it's the same way that you got your how you got your child in there. Like you're going to go there.
I tried to find that one. I couldn't find this one. I found the I'll work on that process, and if I figure it out, I'll share it with everybody in the room as well.
Yeah. I know sometimes it takes a while, and if you're lucky enough to get a hold of the IRS, sometimes they there's different platforms that they have to get it into, whatever it is. But try to get a hold of that. Now, the health insurance, and I was at Mount Bernard, I was in Chambers a couple of days ago, and somebody asked this question, pretty upset about this question that
how's my boy Omar doing up there?
He's doing well.
Mount Vernon Chamber.
Yep. I had what do you call it? One client, actually he's part of Sobro. He asked this question, and he said, he realized that, there was a part of it that says amount that is payable by the employer. So this thing that you get, when you get the 1095-A, do not throw it away, right? Or if it's that C, whatever that you have, don't throw it away, because the reason why these forms are provided is just because now it's become a law, right? During 2008, I think in November years, that, everybody either needs to be provided as employer-sponsored health insurance, or they need to also go to the marketplace. Basically, that's a move to make sure that everyone has health insurance, right? So the fact that you see this figure doesn't mean that you're going to pay anything. However, the only time that, and listen to this, the only time that you're going to pay taxes with this form is if you are an owner, an S Corp owner, a C Corp majority shareholder, and your employer, you are sponsoring 100% of your health insurance. I just want to repeat that. Remember that if you are an owner of a corporation and you decide that you're going to sponsor 100% of your medical benefits, remember that that is regarded as a taxable income.
Because it's an S Corp?
Yes, and because you're an owner, it's a benefit. The IRS regards that income to you.
So, okay, so the S Corp as a pass-through goes into a K1, goes into your Schedule C.
And there's going to be, there's going to be a line on there that's going to say that, do you have any health insurance, whatever. They're going to let you enter this amount as part of the S Corp, and this amount is going to add as part of your income, and you're going to be taxable.
That's interesting, because as a C Corp, that would be a deductible for operating expense.
Exactly.
Wow.
Nana, hi, This is Sabrina. Our last session, you mentioned that maybe I misunderstood you, but for an S Corp, the company can pay for my health insurance. But that if I set up in a what is it called? You mentioned an accountable plan, an account plan. That it's basically is a plan that the company will reimburse me for my medical expenses.
Yes. So
So what's the terminology for that? Because I thought that wouldn't be taxable under me.
Yeah. So let's separate the two things. So remember that if you're an S corp, right? So for instance, if you decide to get health insurance, right? Health insurance for yourself using your S corp, right? As an owner, excuse me. One of the things that you realize that the health insurance in itself, yes, is going to be deductible as a business expense, right? But remember that it's also regarded as a form of compensation for the owner.
Or the employee in this case.
No, for the owner. So let's say, let me put it this way. If you're an employee of an S corp.
On W-2.
On W-2, right? And I'm going to use myself as an example. Like I'm an employee of my company, right? And I'm paying for health insurance. I pay for health insurance for people. So basically, my employees, the company is paying 75% of the health insurance premiums, and they are paying 25%, right? So the 75% that I'm paying is a business expense that I'm going to be able to take. But I said to myself that, hey, guess what? I am going to just let the company pay 100% of my health insurance. That means that nothing's going to come out of my pocket, right? I can make the decision as an owner. But guess what? The 100% as an owner of the health insurance that you're getting, that is a form of compensation to me as an owner.
So it's taxable income. It gets added to whatever you've paid yourself as an employee.
Remember, John, if you remember the PPP, remember there was a part of health insurance saying that they can add that as part of the income.
Yeah.
Right? Yes, that's what it relates to. Right. So I actually just found this.
So what is Sabrina talking about? This is it a prepaid insurance account? I don't.
So what, Sabrina, like I'm not quite sure the plan that you're talking about, but I don't know if you're talking about health insurance or you're talking about 401k.
I'm talking about health insurance.
Okay.
So our last session, you mentioned, because I had asked a question if the S corp can pay the health insurance, and you said
the health
yes.
Insurance for the owner.
For the owner, right?
Yes.
For the owner.
Yes.
And you said that it would be, because you gave an example, 50,000 if that was my salary, then 10,000 for the health insurance, then it would be an accountable plan where I would be reimbursed for that. I have to look at my notes. I'm not going to
look at your notes and let's.
I'm going to look at my notes.
I don't have a one-on-one session with you. We can go through that because.
Okay. All right.
Yeah, because what is happening is that we just want to be careful that we're not, so as an owner, and that's the term on S corp. Remember that an S corp is a pass-through entity, and that's when it's taxable on the S corp level. A C corp is going to be taxed on the C corp level, right? So if you're an employee, if you're an owner, and you're also an employee of your company, right? Any form of benefit that you get from that company is going to be seen as a compensation to you, which includes health benefits, right? But remember that the fact it's a compensation is also going to be, it's basically going to be like a wash, right? Because it's going to also be an expense. But I just want you to know that that is going to be part of your reportable income. So if you're paying yourself $2,000, but your health insurance is $600, basically your pay is your total compensation $2,600.
Okay, thank you. I'll look up.
And we can go through that.
Okay. All right. Thank you so much.
No worries. So basically, you're going to get the form that you're going to get is going to call the 1095-C or -A, depending on the plan that you have, and it's going to have all the information. So next slide. Go down.
Is it next slide or next section?
No, next section. So this is what. Okay, hold on. So this is what we call. How are we doing on time, John? I just want to make sure that I think we're good, right?
It is 6:20. Okay.
All right. So I think most of this, we're going to go over. You already know that. So remember, I spoke about dependents, right? So, and I think Roxanne, I'm going to use it as an example because your daughter just worked. So basically, I'm sure in previous years you've claimed her as a dependent, right? Roxanne?
Saying yes.
Yes, I did. And now I
Okay.
can no longer.
Okay, you can, yeah, that's why I want to make sure that you know that. He can no longer claim it as a dependent because now, but so
Wait, hold on. If she's a college student, though,
but this is the
No,
trick.
I'm still feeding her. I'm paying her
So
tuition and everything.
so this is the thing. So let me explain this to you, right? And don't tell her I said that. So so this is what happens. You can still claim her as a dependent. However, when it comes to her claiming herself, she can't claim herself on her tax return.
Hmm.
That means that if you don't claim yourself, what are you exempted? That means that she's not going to be able to claim the standard deduction.
Zero exception. Oh, right.
Exactly.
She will have the standard price.
Exactly. You got it. You got it. It means that she's going to be hit.
So Roxanne, here's the
made
question.
like $5. So.
Do you want to take the deduction, or do you want to allow her to deduct herself?
Oh no, we're gonna work that out both ways and see which.
Yeah, I figured.
That is a family discussion you need to have on the dinner table. but basically, in your view, in your world, she qualifies as a dependent because why? She made you said she didn't make income like maybe she made income of 2,200. And date of birth, relationship, that's your daughter, and she's living with you, and you provide for 60% of her needs. You have to provide for more than a certain percentage of her needs, right? So the fact that they live with you doesn't mean that they're dependent. You have to provide for them as well. Because somebody can live with you and be contributing, and they're gonna be like, yeah. So that's how the IRS go through all these checks, right? So
she's definitely still a dependent in that respect. Even though she's at college, I do pay 60% at least of her.
But just on that issue, right? So let's expand that. So now she can be a non-dependent on your books because when she's a non-dependent, right? You may still be eligible to claim if you pay some of her tuition to claim some deduction on the tuition that you paid.
Right. I did a little. It's so
little.
Yeah.
So she can be a non-dependent. So she can still be a non-dependent. But you just not going to get that exception, that exception as a dependent, right? But you may be able to claim certain things like education.
So little.
It's so little. It's so little. You're right. It's so little.
It should be 100%. We should be able to claim all of the education.
Yeah.
So I'm going to hit you with a crazy question in a second.
Okay.
Yep. John, you had a question?
Yeah. No. All right. So say I own a C Corp.
Yeah.
Right. I am the single shareholder.
Mm-hmm.
But I'm also an employee.
Yeah.
Right.
Yeah.
Can I employ my wife and my 7-year-old child and give them paychecks to reduce the tax burden of my corporation?
Yeah, absolutely.
And then put my child earning Social Security benefits and Medicare benefits from the time she's 7. And how does that affect me in my personal taxes as a household?
So there's something called the kiddie tax, right? So the kiddie tax law is that your child is going to get taxed at the same rate. So you basically have like a 10-year-old, like I can decide that, come work for me and pay you. They're going to get taxed at the same rate as a parent, right? Your wife, if she's not working, she can, and she doesn't make, now your wife, remember that she doesn't qualify for kiddie tax anymore because she's an adult over 18 that is working. So she has to file her own taxes. Or if you guys are filing together, you just file together as married filing jointly, and she's gonna report her income on a W-2 or whatever it is. So remember, on the company basis as a C Corp, a C Corp is not a pass-through. So the C Corp itself is going to have those as deductions, as salary, as salary deductions or salaries and wages deduction and all that stuff, right? They're going to pay taxes on the C Corp end, right? The only time that you're going to get affected is because you have a W-2. You're just going to act like any other employee, right? The only time that you're going to be taxed again is if you decide that, on the smart way, you want to take out dividends, or you want to take out some other money, dividends. Then you're going to get taxed on the W-2 and get taxed on the dividends as well.
Okay, so I could pay my daughter $15,000, my wife $20,000. Then
there is a limit how much you can pay them. I don't know what the figure is. That I think it's changed. But you can your wife, you can pay any amount that you want to, so far as the company.
Yeah. That makes sense. and then I'll get like 60,000, and my household, my entire household income is less than 100. Okay. And then whatever tax burden my business had, I can reduce it, and then whatever's retained earnings can just sit in retained earnings, right?
Because you know why I can you know why a C corp can sit in retained earnings and an S corp cannot?
Because it's not a pass through.
No, yes, because a C corp is already taxed, so the IRS doesn't care what you do with it. But the S corp has to be taxed, so you have to report it to your personal to get taxed, and then you can decide what you want to do with it.
Got it.
All right. So
And then it was called an accountable plan. I'm sorry, it's Sabrina. I'm sorry. An accountable plan.
Okay. I need to look more into that. Let's talk about that the one-on-one. I need
Okay.
to know what
Okay. All right. Thank you. Thank you.
All right. I know you take down good notes. I mean, I've said that, so we'll look at it.
We're on income.
So income. So now this is the income section, right? So now the income section is you want to gather all the income that you have, right? So what is a key income that everybody has is called the W-2s. And that we've spoken about. You're an employee, whether you're an employee of your S corp, whether you're a sole shareholder of your C corp, you're an employee, whether you're an employee of a regular company, right? So basically, a W-2 is called wages and salaries, and you get a W-2, and it's going to talk about your gross wages, right? Your social security. So what I'm going to look from you, or your company is going to look from you, is that you may not have to even fill this out. Now we need a copy of a W-2, and they can be able to scan in, to kind of get that amount from there. Now make sure that the federal income tax and so New York City has 2 levels of taxations, right? And I just realized that for one of the certain company, they did not do that well. They tax you both on the state level as well as the city level. So those two combined is about 8.7 something percent. So it needs to be taxed at both levels. So if you pay the state level and you don't pay the city level, you're going to pay the city back money. So if you have a company, you have an LLC, and you're filing, you need to file 3 forms. You need to file what you call the Schedule 6 federal. You need to file the New York City one for LLC, and you need to file the New York State one. Those 3 things have to be filed because New York City is also going to want their taxes, right? So the W-2 should be held, but just in case some people didn't withhold it, just remember that that state, New York State doesn't play with their taxes. They're going to come for their money, right? Now the question is that what about if you work in multiple states, right? Let's say you did a gig in New York, and you did something else in Florida, and you did something else in North Carolina, right? But you are resident in New York City, in New York State, right? Wherever the city. Well, what happens, right? Now remember that the city that you are resident in, so what New York City is going to say is that, okay, you know what? You are going to pay as a resident the taxes that you owe. However, whatever that you owe, you're going to file in North Carolina or the other state that I mentioned, Florida, we're going to give you a credit on that, right? That is what we call equalization, where they're making sure that you're going to be paid the taxes to the highest state tax that you owe. For instance, New York State has one of the highest state taxes, about like 9%. So if Florida charges you 4%, right? And they say, okay, Florida charges 4%, right? The difference of 5% is going to be withheld on New York State level. So we're always going to pay what the highest is among all the 3 states combined. I just want to make sure that makes sense, because there's a lot of questions that come in. People come in and they work in multiple states, and you want to make sure that for every state that you've done business in, you need to file taxes in that state as well. Now,
you said that New York, whichever state is the highest, that's going to equalize, meaning if New York, as you mentioned, is 9% and Florida is 5%, then New York is going to only take what, 4.5 or
yes,
and the rest. Okay,
yes.
all right.
But the equalization is that, so So if Florida has already taxed you the 5%, Florida, you're going to get a refund on the Florida returns, right? Because you've already been taxed the whole thing. So all the states, we call equalization, because all the states making sure that you're not paying double taxes in the states, right? But remember that New York State is going to, if you work in New York State, because New York State has a higher, you're always going to pay up to, it's not like up to the highest amount. Some people say, oh, you know what, I'm going to move to Florida and I'm going to move to Georgia and pay lower tax, or let's say Texas, and pay no state taxes. Well, once you move to Texas and pay no state taxes, then you better not come to New York City or New York State, because they're going to get their money, regardless of whether you live in Texas or not. All right. So the second point I want to make is interest
This year we had a lot of people working remotely. So we have some people working in Florida remotely, but they're earning income in New York.
Yeah. So that's a great question. So the way the IRS recognizes where you're a resident of is based on your address, right? So let's say, for instance, if somebody works for your company, works on MBDA, and they decide that, oh, you know what, we're working remotely, so I'm just going to go stay with my parents in Florida and just work. If they still maintain a physical address in New York State or New York City, right, then New York City is going to be like, okay, you're still a resident, so you're going to pay taxes in New York City. But if they say, okay, you know what, I'm going to use Florida, then that means that now you are a non-resident in New York City, so you're going to pay non-resident taxes. However, remember that you're a resident in Florida, so you have to file the Florida tax return, right? In addition to New York State, you need to file those two. But if you're just like, okay, you know what, I'm just going to just hang out in Florida and just work, right? And just maintain then technically you're still working in New York State. But that's why it came a time where the IRS was getting, and this year's the pandemic, they're like, give us your physical address. And when you go on top, the first thing that they ask you is your address. And it's not just a PO box, your address. So your address is going to determine, and then on that, they're going to ask you, did you earn income in any other state other than New York? Because your address you put is going to be your default state of residence, but they're going to ask you if you earn any other income in any other state. That's how they kind of go about it. All right. Interest income, 1099s, let's go down. So the 1099s, remember 1099s for interest, you're going to get what we call the 1099 if you put in the interest income. Go down. Okay. So all these forms, right, and John can send you the slide that we did in the last previous session. So they say if you receive any interest from seller finance mortgage, that's what called your 1098, right? So you want to be able to get out all those forms, dividends, income, right? You're going to realize that dividend income, that's what we're talking about, 1099 DIV, right? So this
Hold
is just
on one second, Nana. Maribel, before you leave, are you still here? I just want to make sure that everyone understands that if you stay to the end, if you're able to stay to the end and you fill out a survey, you get a free one-on-one consultation with Nana. So there will be a survey if you can hang out until the end.
Quick question. Right? How long more can we do? Because I do have another Zoom with Randy.
No, I think Tim, what we can do, John, is that we can just slide through this next 5 to 10 minutes. If anybody has any questions on some of this, we can elaborate on it, right?
Okay, so then in that case, Ethan, put the link to the survey inside the chat room so that the people who are here right now.
It's already 6:30.
Sure thing.
It's already 6:30. So let's just zoom down. Capital gains and losses, we spoke about that. Let's go down. So let's just scroll down and let me see other gains. Scroll down. Okay. Hold on. So pensions, IRA distributions, annuities, and rollover, right? We spoke about that. That is going to be your 1099R. Rents and royalties. So you see the put rent, partnerships, S-corp, estates, and trusts. Remember we spoke about that. The attached K1s for partnerships, S-corp, and fiduciary. Remember we spoke about that during the beginning of the call. So this is where you affect your personal tax. Remember we saw on the personal tax side. So if you get your K1, this is where you're going to attach those. Unemployment compensation. Now, unemployment 1099-G, remember that you need to go into the website to make sure that you actually downloading your unemployment. They don't send it to you. You have to go download it, right? Last year, in March, the federal government came up with a great rule where they said if up to $10,200 of your unemployment is tax exempt. This year, I highly doubt that's going to be the case. So just want to let you know that it's going to be taxable. State and local refunds, social security benefits attached, other income, scroll down, John.
You're saying they're not going to give us the first $10,000 off?
I don't think that is going to happen this year.
Come on, Biden.
Yeah.
What did they put you in for, bro? What?
So scroll down. So I just want to talk about, go down, other incomes, okay, credits. We talk about the child care credit, let's go down. We spoke about that already. Tuition and fees, spoke about that. Estimated tax payments, itemized, okay, let's go to the itemized deduction. I think that's what. So that's what I talk about, the itemized deduction, right? So you can use this list. It's a great list to really compile your itemized deduction to see if your itemized deduction is going to be more than your standard, right? Out-of-pocket expenses, transportation, other hearing aids, glasses, or medical things. Scroll down. Let's see other things that it's talking about. Sales, state and local interest, real estate taxes, personal property tax, interest paid in 2021, right? All these are itemized. You go down, go down.
So guys, fill out that survey. Fill out that survey. I'm watching. Yep. No one's filling it out.
Automobile use in 2021, so let's talk about this quite a bit. If you did use any automobile for car, right? This now is diving into what you use for the business side and what you use for the personal side, right? So just make sure that if you had any automobile that you use and you use for business, you differentiate between how much you use for business and how much you use for personal, right? Go down. Go down, count number one, count number two. So hold on a second, let me see something. Okay, so contributions. So this is what we're talking about, charitable expenses, right? You can put that over here if you had anything. So remember that all this is trying to let you go through this line by line to see if you have any of these things. If you don't have it, it's not applicable. Go down. One of the things that I want to highlight is that New York City was demarcated as a, what is the word, what zone? Disaster zone. So there are going to be some credits that you're going to receive on the federal level and on the state level for New York City because of the storm. So just make sure that when it's a disaster zone, you're checking yes, right?
Where does it say that?
No, when it goes to casualty. Up.
Casualty and losses?
Yeah, casualty losses, yeah. So, okay. Yeah, so just make sure that and if you do your stats in New York State, all the tax preparers are going to know because it's going to apply for everybody in New York City.
So what if my car flooded out and I got reimbursed by my insurance?
If you got reimbursed by the insurance company, you're not getting anything.
Damn it.
Good. Okay. Okay, go down, scholarship. I want to talk about the business revenue and expenses. So go all the way down to business revenue expenses.
No, I almost died, man. Flooded out while I was in it. I think I'm joking. I got pictures.
Now, if you had a home, right? Let's talk about this for quite a bit, right? If you sold a home, I don't know if anybody sold a home or you had a home or whatever it is. All these questions are to get us to a point where we want to realize what your market value is, what your cost is, and how much you're going to pay, right? If this is no, then none of this is going to be applicable to you. Go down. And all these are things that when you have the one-on-one session with me, we're going to talk about your individual needs for all any of these sections. So I say review it before we have a one-on-one, and we can really dive deeper into what sections you think is going to matter to you the most, right? One of the things that I really want to talk about is rent or royalty, income expense, as well as
Schedule E.
Schedule E, yes. Yeah, you know that. That's if you rent any rental property. However, if you have it as an LLC, it's going to be a Schedule C. Scroll down, John. So this is a Schedule E that you put it together. Rental income, royalties received. So if you have any rental, this is the expenses. So you can really use this. If you don't have the P&L, this is a great document to use to actually start compiling your expenses, right? This is a great document to use to start compiling expenses. This is the section that is really important because a lot of people say, oh, what kind of expenses do I claim? This is going to be where you ought to go. Let's go down. John, can you screen?
Yeah.
Okay, it talked about descriptive property. Let's go down. Now, if you have any questions about depreciation and property and stuff, that let's have a one-on-one, 30 minutes. We're going to cover that. This is what I want to focus on. Hold on a second. Business income and expenses for a sole proprietorship, right? This is applicable also to an LLC, a Schedule C. You can also use this for an S Corp if you think that you have a profit or loss, but for an S Corp, you also need a balance sheet. If you do the Schedule C, the only thing that you need is going to be your business income and expenses. And that's the great thing about just having a Schedule C. So the thing is that you want to write down, you want to go down what income that you got, right? Scroll down a bit, John. Now, cost of goods sold, right? That's really important, right? Because remember that if you're in the business of selling any manufacturing goods and like that, you want to make sure that your income or your cost of goods sold, right, is equal to your gross expense. Now, if you are an independent contractor, a sole prop, a single member LLC, you don't have your P&L, your profit and loss, your business operating expenses compiled yet, reach out to John and his group. They're going to send you a copy of this. This is how you're going to start gathering for the whole year. Your advertising costs, your bad debt, your commission, your health insurance, your other taxes, travel, meal, entertainment, utilities, wages. Wages, go down, John. Allocation. So what I'm telling you right now is going to save you a couple of thousands of dollars. Because if you go to a CPA and you don't have this, they're going to charge you over $2,000 just to fill out this form. The rest is not really applicable. Farm, I don't think anybody has farm income and expenses. That's the same thing. So that's basically it. That's like the nuts and bolts. And I recommend that everybody, at least at a minimum, go through these. Try to book the one-on-one consultation as quickly as possible. And business home use, you have a business home use, right? Most of you work from home. We can talk about that as well. What percentage you can charge for your taxes, what percentage that you can charge, you can charge. We can talk about all that stuff. So basically, this checklist is really, really going to help you organize yourself. And it's really key that you go through a checklist before you actually meet with your tax accountant, your CPA, or your tax preparer. And even if you're a tax preparer, have this checklist by you, because what it is that the software doesn't tell you every stuff that everybody needs. When you have this checklist, when your client comes or anybody comes, you can go say, oh, do you have this? Do you have this? Or just hand it out over to them to fill it out, right? So when they're coming, they have their checklist and they have their paperwork, and it makes your whole life a whole lot more easier. Because what's on the checklist is the same thing that the business is going to offer. I'm going to pause over there and see if anybody has any questions. I know we almost up the hour, we're over a bit, but I'm more than willing to answer any question anybody has.